This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Christian Kameir of Sustany Capital. Christian, thank you for joining us.
Thank you for having me, Hal.
We had a previous interview a couple of years ago in which you talked about the blockchain space, and glad to have you back, and we look forward to catching up on it. As we get into it, can you give us a short update about yourself and what you've been doing since our last interview?
Sure, yeah. So maybe for everybody who hasn't gotten the highlight reel, my partner and I have been technology investing for some 20 years. That funny accent that you notice in my voice originated in Germany. I was a developer in the 80s, but then went to law school and decided to become general counsel for one of the early internet service providers. And we just got really lucky selling that entity at the height of the .com to what's now the largest internet service provider in Europe. And so I promptly retired from the law 20 years ago. And then shortly after, I moved to Southern California to set up a venture fund. Our original focus was mostly on multi-massive online player games and host of IP solutions, which both of those topics share a lot with the topic that we're interested in mostly now, which is the blockchain space, as in MMORPGs already in-game currencies with US dollar exchange rates in the 90s, and then voice of IP being the most predominant peer-to-peer solution of its days. So that obviously shares a lot of the blockchain space as such. We were super early in that space. We were one of the early allocators to Ethereum and also run the Ethereum meetups here in Orange County. And most of our focus is on what referred to as value transfer solutions, and then adjacent to that, legal regulatory technologies with a specific eye towards the topic of identity.
Great. So we've had 3 years since we've had our last discussion, and you've done a number of investments since then. So my first question is, what company do you regret not investing in, and why didn't you invest at that time?
Well, actually, we're pretty happy with all of our investments, I must say. It was a really good time to get started and be flexible. So unlike other funds, maybe we'll take our time. We're pretty conservative in our approach with traditional technology investors, which means we like to buy equity in early stage funds. And we also like to see real solutions being developed that solve a problem and also have at least a thesis on the business model, right? In the past couple of years, we've seen a lot. There were allocations to startups that didn't really start out with a sound thesis around how they're eventually going to make money. And that's really not how we operate. We're very scientific driven, both how we think about the space, and we will also want to see this from the startups that we're investing in. So as such, all of our investments have fit this criteria, and they continue to grow. Some of them are doing absolutely great. And that's why we're raising another fund right now, because we will see those businesses grow specifically in that current scenario over the next couple of years. So for us, the current conditions are actually, I wouldn't say favorable, but definitely not detrimental.
Great. So which sectors are you really seeing grow and do well, and which are not? And was it what you expected 3 years ago?
So most of it was what we expected. As always, there's kind of this over-optimistic expectation for most younger startup founders, and we don't necessarily subscribe to those. And that has kind of held true. Everything's going, generally speaking, a little bit slower than most of them expect. But for us, we bake this in, right? So our expectation, whatever someone tells us, is several orders of magnitude smaller. So there were a few that exceeded that. Those are the outliers. Those specifically hold true for crypto-related lending systems. They have done really, really well. And specifically because of the market movements, I think. But at the end of the day, for us, really, it's about building core technologies. And moving forward, I think we will see much more, because now, as you saw with the distribution of those payroll protection programs, etc., it shows yet again all the inefficiencies that we have in legacy financial technologies. And that's actually our focus. we focus on specifically financial expediency, financial solutions that replace the existing legacy financial systems, which, if you think about it, your bank account hasn't really changed in its functionality, if you want to take this as an example, for quite a long time, right? They're just really old legacy database systems, right? And there's some cosmetic solutions that have been put on top of that, but fundamentally, they're still relying on a lot of old legacy tech. And we are specifically focusing on those. As a starting point, anything that's quote unquote money technology. But then what we'll see moving forward is more complex products, right, that deal with other types of securities that actually then will require that specifically identity is being addressed. And also that has gotten focus from governments around the world, given the current conditions.
Great. Can you talk about maybe a good experience you've had with one of your portfolios, and why was that a good experience? What was in there that made that a nice investment and a nice working time?
Yeah, so we like working with very, very smart people that are also able to adapt and learn, right? So one thing that you want to see strong conviction, but we always say strong convictions loosely held, as in we see a lot of different solutions, right? So before we made our first investment in an identity-related product, we looked at hundreds. And our takeaway at the end of the day was, well, they all don't seem to understand kind of what the core problem is. They're all dealing with something that's more like second, third layer. So we found one company, after looking around for a long time, they seem to understand this and were very, very eager to actually get our feedback. And so since, as I mentioned, we are very scientifically minded, we really engaged with them in a peer review process and could immediately see that they were soaking everything in that we suggested. So they specifically deal with biometrics, and they are specifically also then the protection of that biometric information. If you think about this, if and when all your biometric information at some point in time is available digitally, if we let the same circumstances happen that happened with your personal identifiable data, that your personal identifiable data is probably in 4,000 databases out there. And at this point in time, a lot of people realize, well, it probably wasn't a good idea that we let Facebook and other companies accumulate several thousand data points about us, because at some point in time that got copied over and then copied again. And once it's out there, if it's available in digital information, it's really, really hard to pull back. So coming back to the biometric example, think about it this way. If that's for future implementation is being used, i.e. to log into your bank account, as in recognize my face and log into your bank account, or access to an airport terminal, access to an office building, if that was available online, and you probably know about 3D printing techniques and probably seen Mission Impossible, can you imagine what this would mean for the future of security if you don't address this particular problem from day one? And so they specifically just focus on that. So starting with biometric of your face, but then also gait recognition, so the way you walk, but with an extreme focus on encryption, with an extreme focus on decentralizing that data, so that what we had happened in the past doesn't happen again. So we're super happy with that particular investments, and we'll strategically help them in other areas and fit them with other ones of our portfolio companies and other interests that we already had. And this is one of those key technologies that you will see time and time again being implemented in other solutions, right?
Great. And can you talk about maybe a challenging experience for the startup, and why was that challenging? What was missing from the mix that didn't make it a great experience?
What we see kind of a lot is that there's a lack of focus, right? And I actually just got off another call before I jumped on this podcast with you, where that seems to be apparent again. As an investor, you want to see focus on one particular strength that a company has, right? You can always expand later, vertically or in a different direction, but you want to hone in on what is the actual value proposition that you can provide right now. And so we saw this quite a few times with existing companies that already had some form of traction, but then rather than doubling down on that particular traction, they try to add a product or try to enter another vertical, try to address different customer needs. It's super important as a startup founder that you double down on the things that work. And there's always kind of this huge excitement about, hey, I also could do this. I see something over there that other companies are doing. I can do this too. Well, that might be true, but at the end of the day, that's not going to let you grow. You want to double down on the things that clients and paying customers already coming to you to subscribe to, right?
Great. So can you give us an update about the blockchain space today on the regulatory, the technical, and then the market? Let's start with the regulatory. As last I looked, the SEC was still holding fast and not moving forward on loosening the rules around financial transactions and so forth. But where do you think we are today with blockchain and regulatory?
Honestly, it's not really an interesting topic to talk about, in my opinion, but I'll give you my 5 cents. As I mentioned in the introduction, used to be a lawyer, had also some regulatory exposure. I wrote some of the deregulation papers for the European telecommunication markets. So I understand a little bit how these think. But here's the big but. Needless to say, blockchains by nature, quote unquote, don't restrict themselves to any nation state, right? So that's why I used to tell people whenever we had these discussions, there is no such thing as a regulated token or regulated blockchain solution. It cannot exist, right? Because again, you're immediately addressing the world. It's kind of the same as the World Wide Web, but it doesn't extend to the borders of the United States. It's accessible everywhere. And blockchain solutions by nature are the same way. So as far as particular products that are being integrated and then interact with blockchains, i.e. specifically the kind of nasty topic of legacy financial products, so specifically fiat money, right? Well, fiat is not really money. So we are finally now seeing actual technical solutions that will then not need regulatory oversight. Because at the end of the day, I think what most people don't quite realize is that we still haven't fulfilled the initial battle cry of the Bitcoin white paper. Because if you read the title, it says peer-to-peer cash. We still don't have that, right? So, but what are the tenets of cash? The tenets of cash is that I'm sitting across from you and I hand over a $10 bill to you. That settles the transaction. There's no fees attached to that. And it doesn't take more than me handing over the cash. It doesn't take any time, right? That's still not the case. That's still not the case for any digital bearer instruments. And we have digital bearer instruments, i.e. lowercase b Bitcoin being the mining reward on the Bitcoin blockchain. But they're all still laden with fees and time delays, right? And so if and until that is not solved, then the most simple product, money, doesn't really exist in a competitive form. And there's a huge danger here because now we have this revigorated discussion around central bank digital currencies, which is kind of a window dressing term since obviously most quote unquote money still only exists in digital form anyway. So money has been digital, or currencies more accurately have been digital for decades, quite obviously. So the default medium of exchange has moved to bytes a very long time ago. That's why there's always this confusion that Bitcoin might be a medium of exchange. No, the medium of exchange has been the same for all currencies for a very long time. It's just bytes, right? And you don't need to actually attach any value to that, right? Bytes move at the speed of light. So what I mean by that is at the end of the day, people have accepted that fiat is just a unit of account. It's the price sticker that you see on your banana, and it says this banana is $1, so you understand what value you need to hand over. If I asked you to pay in Bitcoin, you would have to take out your calculator and figure out how much Bitcoin is $1 right now, right? And that obviously won't happen. So long story short, there's a huge challenge right now if and when we have what central bankers call central bank digital currencies. If these are still based on legacy technologies, your current bank account is a DLT, is a distributed ledger technology, right? So when you send me $100, then you call up your bank, you log into your bank account, and they adjust your account. And then if I'm lucky, my bank will just my account the next day, my ledger the next day, right? And in between, the banks will reconcile with the Federal Reserve System. So that's a typical example of a federated DLT. So the difference between CBDCs, central bank digital currencies, would be that this commercial bank aspect will fall away. So it's no longer federated. It's just a centralized DLT, which is actually the opposite of what we need. It's no longer a digital barrier instrument. So it might not be such a bad thing for countries with a democratic government, but obviously, if that is the only money that exists with physical cash going out of style, you have complete capital control. And so that's why it's very, very important that people understand that we still need to develop digital barrier instrument in form of digital cash, and that we implement things that actually resemble something that people understand, where you don't have to think about what is the price of your banana in Bitcoin, but you can just hand over digital cash that's denominated in dollar, but the underlying value really doesn't matter, right? You don't care. I hope that wasn't too long and convoluted.
No, it's the challenge of the regulatory is trying to match the crypto price with the fiat price, and the fact that crypto is not confined to one nation state. There's a lot that goes to that regulatory, and it sounds like it's moving, yes, but fairly slowly too.
Yeah, it's moving in different direction, but the larger problem is, and I just posted that to Hester Pierce, who you probably know by name and who had a discussion about that some time ago, is that we actually need to establish a more interdisciplinary discourse, because specifically the lawyers involved with the regulation, they don't know technology. And they're trying to, I always say, try to fit these square pegs through the round holes of cryptocurrencies and blockchain. Cryptocurrencies being a terrible term, but the point there being is they are new instruments altogether, right? And it's actually very much contextual, and we really don't need any new regulations for that. Think about it this way: money specifically is a secondary agreement of a transaction. So if you and I decide that in between us exchanging value, pencils are money, then pencils are money, right? It's always a secondary agreement. Every contract, every purchase contract that you make, you pick whatever you want to pay with. Typically, people will default to the fiat of their nation states, but there's no law that requires you to do that. The only time when there's a law is if you need to pay taxes, fines, and fees to the government. Otherwise, you can agree with the counterparty whatever you find acceptable as the quote-unquote medium of exchange. And so once you understand that, then you can actually implement the right technologies, because this comes back to people still don't understand Bitcoin as far as the mining reward is concerned. It's a functional element of that blockchain. Maybe Satoshi had that idea of that being peer-to-peer cash, but obviously that hasn't held true. He simply didn't understand the importance of money in its current implementation, that people accepted the fact that money is by default inflationary, so I store value in other things. Everybody does. You don't store $1 million in your checking account. So as such, the remaining function of unit of account has not been addressed in the original white paper, i.e. specifically, there is no minting function. If someone created the minting function, then you could realistically expect this to be eventually cash. But as long as that's not true, you can't. And that would actually make adoption much easier, right? And again, it comes down to no one actually has the right to tell me what you and I can exchange as value, right? I mean, maybe in some dictatorial nation states, but most certainly not in democratic societies with open markets like ours. And I hope that will become standard around the world. That money should have always competed as the simplest instrument, right? You want money to compete. And people then make the argument, well, it's already competing internationally, like the euro competing with the dollar and so forth. That might be true on the FX trader level, but for you and I, that's not really practical, right? I cannot wake up in the morning and decide, well, today I'm going to switch my currency, right? My unit of account.
Right. So let's talk about the technical aspects of the industry, especially blockchain. It seemed like 3 years ago, it was at the very nascent stage. People doing very basic infrastructure level work and so forth. How has it progressed in the last 3 years as far as technical tools, technical platforms, and just in general being better systems available to those who are developing these applications?
Yeah, so there has been a huge search around this whole topic of decentralized finance, which is mostly happening on the Ethereum blockchain. So it's implementations of solutions that do not require any middleman, to where you can create lending systems that are purely driven by the user, right? And you see more and more applications popping up in that regards on a daily basis that have to do with lending, with escrow, and so forth. And the tools, let's call it middleware, in that regards, being developed on a weekly basis. There's something coming out on there, basically on a weekly basis. It's still mostly geared towards kind of more the geeks in the space that understand the technology at large. But I think we're going to see solutions that will cater to the everyday citizen very soon. I mean, the most obvious examples are all the kind of quote unquote stable coins, right? Which most of them are pegs, as in like USDC, Tether, and so forth. They're all backed by the US dollar, right? That's 1-to-1 exchange rate to the US dollar. So unlike the US dollar, though, that I cannot make it immediately available to the lending market, and I would have to like open up a CD and get interest on. And DeFi systems, I can make this immediately. Stable coins or US dollar peg can make this immediately available to credit market. So that means if you had a checking account that would seamlessly let you move from those instruments whenever you wanted to, you could always have that cash being available to credit markets and make interest. And at the height, and there's applications that do this that we invested in. Some of them are centralized, some of them are decentralized. So they're still somewhat hard to use, and it's mostly limited to people in the space. But once you have interfaces where it becomes seamless for the user, where it just seems like it's your checking account, and whenever it's just sitting there, it's earning you interest, and it's optimized to make you the most interest, why wouldn't you want to use it, right? Because instead of losing 2 to 10% a year because of the inflationary nature of fiat, you could make the opposite of that. You could make 2 to 10% a year for it just being available to credit markets. So think about it as basically checking a box saying, hey, you want to make this cash in your bank available to credit markets, which is right now a privilege that commercial banks have. But you would extend this to the general user. And we have seen over the course of the past couple of months, interest rates as high as 11% APY.
Oh, well, great. Well, Mark Andreessen recently said that everything that was attempted in the .com era can now be done.
Yes.
Only it's 20 years later. Do you think we're in for a 20-year development cycle before all of the things you want to do can be done technically? Or do you think it's going to happen faster?
It's going to happen faster. Yeah. So I think it's probably 10 years. And so
okay.
Mark and I think very much like, we don't talk much, but we kind of had the same experiences along the way, right? Like him being the early developer of initially the Mosaic browser. My first blog post in 1993 was about the Mosaic browser. But we are excited about the exact same thing, and what I call to build the World Wide Web for the first time. And that is actually my main motivation. So if you look on my private blog, I started writing an outline to do this 14 years ago. So the idea really being to create the initial vision of the decentralized World Wide Web, decentralized information exchange. Right now, what we have is not the World Wide Web. We have the commercial web, right? It's controlled by very few commercial entities for access and eyeball distribution at the end of the day, right? Most people have never seen the World Wide Web because usually what people refer to the dark web, quote unquote, that's really the World Wide Web. Because if you're going to Google and you search something, you technically don't search anything. You're actually just running a query against the Google index, which itself is entirely polluted by, let's call it SEO, right? That's all content that's specifically written for Google. And so, yeah, I couldn't agree more with Mark there that we will now see the World Wide Web actually come about. That's why I was never a fan of terms like Web 2.0. That's really a marketing term, because if you just look at the source code on any website, it's held together by HTML, right? If you pull out the HTML, the World Wide Web doesn't exist. And we never really completed that particular stack. I was initially very much involved in movements on the semantic web, which never went anywhere. So specifically topics of tagging and so forth. But now what's more important too is the obvious one is we're developing all the value exchange layers. They were missing, right? The initial World Wide Web, quote unquote, is a protocol layer of information distribution. We didn't have a protocol layer for value distribution, and that's what blockchains could be considered. But then also, and maybe more importantly, we'll have identity implementations, because for a lot of value exchange, you actually need to identify who is the rights holder and or who is the asset holder, which are entirely two different things. And today, that's actually not possible, right? So you would still have to have some custodian in the middle that facilitates any type of rights transfer. Think about houses, think about cars, and so forth, right? You can't right now do this.
Great. Well, let's talk about the market for a moment. In 2017, there's quite a bit of investment going into startups, and of course, startups, it takes 2-3 years to produce a result. What kind of results are we seeing from those 2017 investments in this year?
Well, as you would expect, 90% of those aren't around anymore. Specifically, a lot of those that had the idea, hey, we want to do an initial quote-unquote coin offering, and we introduce a token that doesn't really solve any needs. I mean, we still see some of those startups around that had that initial ICO. And my typical response to that is you need to clean that up, right? So it's like, see who are the token holders, but in your particular scenario, there's no good reason to have this particular instrument. There are good reasons for very selective systems, but honestly, at the end of the day, it's kind of the cart before the horse, as in you typically want to establish what an incentive model first that has nothing to do with value exchange. It's just, let's call it a point system. Once you establish that people are interested in accumulating points, well, eventually you can move this into some form of quote-unquote digital currency, but that shouldn't be a starting point. You cannot make the assumption that, hey, I'm going to create 1 billion of these things, and then somehow by magic, this is going to work out. So this is to say that, and that's easy to follow on sites like CoinMarketCap, you'll see that 90% of these things went to zero. And they, at the end of the day, will drag down the projects that are attached to that, right? Because it just creates a huge liability. Because if you think about it this way, if you were an initial buyer in these tokens and you actually spend a significant number, and by the way, there has been this battle cry from the SEC and other regulators that mom and pop got into that game, that has actually never been proven. And I would dispute that vehemently, because it was very hard to participate in those startups. You had to buy Ether, you had to, for the most part, very early on do KYC and a lot of other technical things in order to get your tokens, install a wallet. And so it was really 50-some% came from professional investors like us, including Mark and so forth. And then the other part is pretty certain it came from geeks that were early in the space, that were miners and otherwise already involved in the space. That's why they had Ether to spend on these ICOs, because face it, there was no US dollars going into these, right? That's the other mistake that is always being made in terms of 2017. It's always denominated in US dollars. Actually, you would have to look at every single project and actually see what did they raise, at what time, what was the conversion rate, did they actually sell it, right? And then if they sold it, did they pay taxes on it if it was a quote-unquote utility token, right? And so there's a lot more analysis and not more nuances, and you need to be aware of to talk about these things with any type of sophistication. Unfortunately, given the current media landscape, you get a lot of these clickbaity articles, right? Like ICO scams and whatnot, without actually trying to understand what's actually going on. Because yes, there was a lot of experimentation, but that's always the case. That's a good thing. I look at the entire cryptocurrency market as a multi-massive online player game. And I don't mean this disparaging. We should have done this before we created the stock market. I mean, the stock market today, I would not recommend anybody engaging with that. What's the value? And what is specifically for those companies that are traded there? And they're specifically, if it's not founder run, right? And that was, to go on a tangent here, a large part why it imploded, right? The whole coronavirus was just a trigger. It was clear, I think, to everybody that this bubble would be bursting, right? And anyway, so larger point there being, coming back to 2017, more experiments means also more experiments failed, but there's a lot of good lessons. And even the people that created startups and initially tried something that didn't work, they are now on their second startup, right? We see a lot of teams that recycled into something new. It's still somewhat a nascent space, and I always have this little shortcut to know how long someone was in the space, which is I compare how many connections we share on LinkedIn as a frame of reference. Like one of the guys that started at the same point in time that we invested in, we share 2,500 connections. And so moving it down from there, I can roughly tell how much experience someone had in the space as a starting point.
Right. Well, great. Well, it's glad to hear that the great things came out of 2017, 90% failure rate. That is a standard in the startup world, but it, great highs and great lows, I think, were achieved in the last 3 years through that process. And I'm sure it's establishing a good foundation for the next generation of startups, as well as technology and team members that are coming out of it, having so much more lessons learned. So I guess in the last few minutes that we have here, what else should we cover that we haven't?
Oh, there's so much that people should be paying attention to right now. Yeah, maybe I reiterate the current discussions around two topics. I think everybody should pay a lot of attention to the proposals that are coming out from the central banks in terms of revamping money technologies. There is a huge danger there that we centralize money in different jurisdictions. The United Kingdom seems to have a more nuanced and educated opinion on that. So I ask that everybody is looking out for those proposals that are coming out of the United Kingdom. A lot of the things that I'm reading coming out from the central banks here have me worried. Because if you think about this, if you have money being completely controlled by the state, quote unquote, that is a very, very dangerous thing, with specifically now where people are probably more reluctant to use cash for health reasons, as in it could carry some viruses. I think a lot of people will just simply stop using cash altogether now. And there's actually more cash usage still going on than most people think. So I think that's a very important topic to understand, and there specifically ignore the nomenclature that's coming out from the central banks, as in calling it a central bank digital currency. Of course, currencies have been digital for decades, right? So that's not the difference. The difference is that they're trying to get rid of the federated nature of that technology, which, again, lends itself to complete capital control. Not a good thing. You don't want that. The second part is that topic of identity specifically. And there we will see a lot of new solutions. And there, again, it's very important that people pick the right solution for their application. I mean, now finally, after all these years, there's more awareness on the dangers of having your digital data out there and getting identity stolen. That's typically how that's referred to, which is really just people having a collection of your data that allows them to do something nefarious with usually a financial service provider or something else. But there we will see solution that finally move towards what's called self-sovereign identity, to where you are in complete control. And we just had a little discussion on Forbes around that topic, specifically how to protect your personal data, because now there's this parallel movement of tracking people specifically for the purpose of disease prevention, as you know. So if that opens up a backdoor to something that's more like the Patriot Act, which obviously is a euphemistic term for Surveillance Act, that again would lend itself, just like those capital controls, to complete state surveillance. And I don't think that as freedom-loving Americans, that's something that we want to see in our future, right? So those are two topics that are on top of our mind, from identifying the quote-unquote right, meaning sustainable technology solutions, and seeing those being implemented by not only technologies, but also by governments, right, at the end of the day.
All right. Well, I appreciate you catching us up on where we are with blockchain, the technical, the market, as well as the regulatory. Moved quite a bit forward, and glad to see things are progressing so well, and it sounds like you're doing well as well. How best for listeners to get back in touch with you?
Yeah, the easiest way to see what we are up to is go to my Forbes page. Typically, I publish something every 4-6 weeks on there, and it will always touch on the things that are on top of our mind. And the way I handle these, it's not to get accolades on our type of thinking, is really for peer review. And so to that extent, there will always be follow-ups on that. So we'll typically move the discussion later on to Hacker Noon, where we expand on those thoughts and really using a scientific approach there. So if you're interested in understanding money technologies, value transfer technologies, identity and regulatory technologies, and what to invest in, that's where I like to have peer-reviewed discussion on.
Great. We'll add those to the show notes. I want to thank you for joining us today and hope to have you back for a follow-up again soon.
That sounds good. Let's do it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org.
Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.